Welcome back to Investing Talk Podcast.
Today we're looking at HUT8.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. HUT8 has historically been seen as just another Bitcoin miner, super cyclical, tied to the ups and downs of the crypto market.
Right. Totally at the mercy of the Bitcoin price.
But what we're seeing now is a really significant strategic shift. Management has been executing this pivot, moving away from that volatile model.
Pivot towards what exactly?
Towards becoming, well, essentially a high-margin, contracted energy and compute platform.
And this isn't just talk, is it? I mean, the latest financials, the Q3 2025 results, they seem to back this up in a pretty dramatic way.
In a huge way. The numbers suggest the market is maybe not quite grasping how fast this change is happening. That's really the core idea we need to unpack.
Okay, so let's hit the big numbers then, the ones that really tell the story.
The headline figures really show a company that is just successfully leveraging its infrastructure investments.
Let's start with revenue. It came in at, what, $83.5 million for the quarter?
Right, which is a 91% increase year over year.
A 91% jump.
Right.
But if you want the metric that really shows the structural shift, you have to look at the bottom line.
Yeah, the net income.
Net income surged to $50.6 million. And that's compared to just, what was it, under $1 million the year before?
Just $0.9 million.
Yeah.
So, yeah, that jump is obviously the huge headline. But you do have to remember that does include some digital asset gain.
Sure, non-cash stuff.
Exactly. So the more critical number, for me at least, the one that strips out that volatility, is the adjusted EBITDA.
The operational metric.
Yes. And that number, it just skyrocketed. It hit $109 million.
Wow. And that's versus, what, 5 or 6 million the year before?
$5.6 million. So you're going from 5.5 to $109 million.
Yeah. $109 million in operational EBITDA. I mean, that tells you the platform itself, the energy and the compute together, is just pumping out cash. It's not just about Bitcoin going up.
That's it. It shows serious operational leverage. And that strength is undeniable. It leads you right to their core strategy.
The power-first strategy.
The power-first strategy. The whole design of the business is now about minimizing that exposure to, volatile spot prices.
And I think that's the most important thing for you, the listener, to really get. Most miners are just merchant miners. They mine Bitcoin. They sell it for whatever the price is that day.
Right.
HUT8 decided they didn't want to play that game. So how did they actually pull off that stability?
Well, I made a very aggressive pivot with their power segment. Instead of just generating power and selling it on the open market at whatever the fluctuating rate is.
Which can be all over the place.
All over the place. Instead, they focused on locking in long-term, high-quality, contracted revenue. They're basically pre-selling their power for years at a time.
Yeah.
It's a deliberate choice to de-risk the business.
Okay, so what does that look like in practice? In terms of, like, a hard number for stability?
It looks like this. Over 85% of their managed energy capacity is now locked down.
85%.
Under contracts of 1 year or longer. And that metric is huge. It gives you incredible earnings visibility and recurring cash flows. It starts to look a lot more like a utility company or maybe an infrastructure REIT than some speculative tech play.
And with that kind of guaranteed revenue, you'd expect to see some pretty exceptional profit metrics. We saw the EBITDA margin was sitting at, what, around 84%?
84%. And the gross margin was 43.4%. No. That kind of margin structure is just, it's not what you see from a typical cyclical commodity player.
No way.
It really points to that competitive advantage of being integrated. When you own the power plants, you control your biggest cost. You guarantee your own supply. And
it seems like they've managed to do all this without loading up on debt.
Not at all. Actually, quite the opposite. Their balance sheet is remarkably clean. They've got a debt-to-equity ratio of something like 0.02.
Basically zero.
It's extremely low. And that financial strength gives them a ton of flexibility to fund their expansion plans without, having to sell more shares or take on expensive debt.
Okay, so let's talk about that future then. Because the real competitive moat isn't just owning the power, it's what they're doing with it. The compute platform.
Exactly. The ability to dedicate that power you own to high-margin hosting and computing, that's the heart of the moat. We're talking about running facilities for clients who need huge continuous amounts of energy.
Like ASIC mining collocation, but also...
And increasingly AI, high-performance computing, or HPC.
And we're seeing proof of that demand. The ASIC colocation revenue jumped 31% year over year to $5.1 million.
Yep, mostly from their Vegas site ramping up. It confirms that the demand for their hosting is accelerating, but you have to look deeper at the strategy behind that revenue.
You mean the Bitmain deal?
You have to look at the Bitmain relationship. Hut 8 has this strategic colocation agreement with them, supporting nearly 15 exahash per second of capacity, and they're using these co-developed next-gen machines.
So this is more than just a simple landlord-tenant thing.
Much more. It's a technological validation. You have Bitmain, a leader in this space, trusting Hut 8's infrastructure with their newest, most advanced equipment.
And the financial result of that collaboration is pretty clear. The gross profit in that specific hosting segment grew, what was it, 10 times year over year?
By a factor of 10. And the gross margin expanded to 68.6%.
That's a specialized tech service margin, not a mining margin.
Exactly. So when you ask what is the moat, it all boils down to them being a truly integrated platform.
Right.
They don't just rent power. They own and operate 4 of their own natural gas-fired plants in Ontario.
Let's break that down, though. Why is owning the power so critical? For a listener who's maybe not in the energy industry, why is that such a huge barrier for competitors?
Just think about how complex it is. Building any new large-scale energy infrastructure today is incredibly difficult.
The permits, the regulations.
It takes years. The permitting processes, securing the power purchase agreements, getting interconnection approvals from the grid, it's a nightmare.
So it's not just a matter of having the money, it's time and bureaucracy.
Precisely. If a competitor wanted to build what Hut 8 already has as permitted, contracted, low-cost power, it could seriously take them 5 to 10 years.
Because of all the red tape and, local opposition.
Yeah.
And IMBOs.
Exactly. Hut 8 already has those permits. They have those grid connections. That existing footprint managing over 23.7 exahash, that's a massive, almost irreplaceable head start.
Okay, so despite these amazing fundamentals, the $109 million in EBITDA, the 68% hosting margins, no debt, the stock has been all over the place. We have to address that. Why hasn't the market fully rewarded this transition?
That's the big question, isn't it? It's about market perception versus fundamental value. Because while the financials are strong, the stock is still so sensitive to all the noise. It sees these huge drops.
Yeah, 12, 14% in a day just because Bitcoin sells off. The Crypto Association is still, driving the narrative.
Yeah, it absolutely is. And then there's a very specific issue that's acting like an anchor on the stock. We have to talk about American Bitcoin Core, or ABTC.
The spinoff.
The former spinoff, yeah. That entity collapsed. It plunged over 85% after they separated. And the news flow keeps linking the two, which is penalizing Hut 8's valuation.
So investors are worried about some kind of lingering risk or just reputational damage.
I think it's both. Even though Hut 8's own balance sheet is totally insulated, the market is judging them by association.
That seems to be the conflict, right? The market is failing to give them credit for the diversification into HPC and contracted infrastructure, which, it strongly suggests a potential mispricing.
Absolutely, especially when you compare their asset base and predictable cash flows to where they're currently valued.
But it seems like the institutional investors, the so-called smart money, they might be looking past that short-term noise.
There's definitely evidence of that. We're seeing some notable accumulation. Northern Right Capital Management, for instance, they just upped their stake by almost 50%. Yeah, they're holding close to 1 million shares now. And that kind of high conviction bet tells you that sophisticated investors are looking through the daily volatility and the ABTC drama to see the real infrastructure value underneath.
And for anyone focused on timing, the technicals seem to line up with that undervalued story, too.
They do. The technical models are showing a pretty constructive setup. These recent pullbacks into the mid-30s are being seen as, attractive entry points for investors who believe the fundamental business will eventually win out.
So the market is essentially offering a discount because of the complexity.
That's a great way to put it. Now let's pivot to the forward look. The core mission here is expansion. They have this power-first strategy, so where does that take them next?
In terms of scale, you mean?
In terms of scale, management is pushing this huge expansion program. They're targeting over 1.5 gigawatts of energy capacity under management.
1.5 gigawatts. That's an enormous amount of power.
Yeah.
And that's enough to run a small city. What does that mean for their revenue down the line?
It means they have a very long runway for contracted growth that is almost entirely separate from Bitcoin's price. The goal is to fill that massive new capacity with more long-term, high-margin hosting deals.
Which would just further de-risk the whole business profile.
Exactly. And it shows they're investing in the infrastructure and energy side, not just buying more mining rigs.
And analysts seem to be buying it. The average 12-month price target is up around $48.80, which implies a lot of upside from here. What are the specific catalysts that could get them there?
Well, the new term one is just delivery. The Q4 earnings, which should be out in February 2026, they have to show that $109 million in EBITDA wasn't a fluke.
That it's the new baseline.
Right. They need to keep proving that the underlying operational strength is separate from the digital asset volatility.
Okay, and now for the really big one, the speculative play. The AI upside. Everyone's talking about the power needed for AI compute. Is HUT 8 really positioned for that, or is that just market hype?
It's more than chatter, but you're right. It is speculative for now. But think about it. HUT 8 has what the hyperscalers and the big chip manufacturers need most.
Power.
Permitted, interconnected, large-scale power capacity. That is the #1 bottleneck for building new data centers to train these giant AI models. They are absolute power hogs.
So if you're a Google or a Microsoft and you need a new data center running fast, HUT 8 basically has the ready-to-go power and land that you need.
Precisely. The ultimate home run catalyst here would be an announcement. A new major long-term AI or HPC hosting contract that goes beyond the Bitmain deal.
That would be a game changer.
It would fundamentally re-rate the stock. It would move it permanently out of the crypto miner bucket and put it firmly into the AI infrastructure category, which, let's be honest, commands much higher valuations.
Okay, so let's tie this all together as a final thought. What you have with HUT 8 is a company executing this really dramatic pivot. Its core financials, the 85% contracted power, the huge operational EBITDA, the low debt, they all scream stable high-margin infrastructure play.
They do. Yet the market narrative right now, because it's burdened by that ABTC anchor and the Crypto Association, is treating it like a super speculative asset.
It's a remarkable contradiction. The underlying business engine shows incredible soundness and structural strength. They're building this foundation for huge future growth with that 1.5 GW expansion.
So the question for you, the listener, is this. How long will it take the market to stop looking at all the noise and start valuing the contracted infrastructure that's sitting right underneath?
If you found this analysis helpful, please make sure you subscribe to Investing Talk podcast to catch our next deep dive into the markets.